right, so we're back for our November economic update. I'm John Cleaver. This is Dennis Bacon. We're Beyond Wealth Advisors. We're excited to be back. Believe it or not, we're getting close to the end of the year. Thanksgiving's just a couple weeks away. And we're going to keep it really simple today. We've got really one very important topic that we're going to dive into.
Deer hunting?
No, not deer hunting. We're going to talk about inflation.
Okay.
Is inflation real?
Well, there was a very well-known magazine came out in May with a long article that said inflation does not match reality. It doesn't exist. Well, since then we've found out that used car prices are up about 30%, gas prices up 50%, home prices, geez, who knows where they are. Depends on where you are, they're up a lot. And we just had a report here today that the year-over-year inflation is running at about 6.4%. Right. I think we kind of talked earlier that we were thinking it'd be somewhere over 6%. Right. You know, the prognosticator has been saying it's going to be somewhere around 4 to 5. Looks like the 6% number is real right now.
So inflation is real?
I think inflation is real.
Inflation is real. All right, so what do you do about it? How do you protect your buying power if inflation is real and probably here to stay for at least a little while?
Okay, well, that's a challenge. Everybody hears about inflation. You know, if you've been around investing for a long time, you kind of get a feel of what inflation really impacts. From an investing standpoint, you really need to ride the wave of inflation in a lot of ways. If you sit back and pull all your money back and make it super safe and you have inflation, well, your buying power just got deteriorated. Right. Inflation, if we have inflation of 20% over a 3 or 4 year period and you're sitting in cash earning 1%, obviously you don't have as much buying power. And really that's really what we're talking about is buying power. With the inflation, we do expect a lot more stock market volatility, pretty typical during inflationary time. People get fairly emotional about it, justified and unjustified. There's both ways, so not a judgment on that. But what I think really, there's a few things that really make a lot of sense in that time. One is if you have well-positioned real estate, that can make sense because it's going to ride the inflation wave, and you know they're not making any more new real estate. It's just the reality. Commodities can work really well during that period of time also, as long as the economy is staying on track. If the economy starts to falter and we have a recessionary time, which sometimes happens, then commodities, you kind of want to unravel your commodity exposure at that point in time. On the stock side, really value stocks are really where you want to be. And they tend to do a lot better. Your high-flying stocks that high PE multiples tend to fall during that period of time. Right. And interestingly, on the value side, though, you don't want to be in the high dividend-paying stocks because they're being bought because of their dividend. Well, if all of a sudden you have inflation at 6% and their dividend is 3%, you're losing buying power. And so tends to not be the best place to be. Small and mid-cap stocks on the value side tend to actually outperform large caps also. That doesn't happen every time, but that typically is where we see things happening. So I know we're looking at that in what we do with our strategies and our clients. We're looking at making some adjustments for that to happen.
And have made some over the last year.
We've made some recently.
So, all right, so you talked about stocks, you talked about commodities, real estate. There's a whole other segment of the market called fixed income, bonds. We know bonds can be impacted by interest rates, inflation. Where do you see fixed income products as we head through this cycle?
Well, this particular cycle, that presents a real challenge. Right. We've been trying to move people into other assets like real estate and some other areas, because if you're getting 1.5% on your bond, and inflation is at 6%, you're losing money, right? Right. But also that 1.5% is getting taxed. So you may really only be making 1% net of taxes, but yet your buying power is at 6%. So you're getting hammered. Now, the other thing that can happen bad with bonds is if we see with inflation, you tend to have escalating interest rates. If you currently hold a bond today and it's paying 1%, 1.5%, and new bonds are being issued at 3 or 4% in a year or two, that 1% bond's not worth as much. So what you have is you also have a devaluation of the bonds at the value of the intrinsic bond, plus you're not making interest. So we look at this being a very difficult time for the bond market. And so safety, is a challenge.
Right.
And we just have to maneuver through that through each action that happens.
So in other words, you're not necessarily getting rewarded for being more conservative, like maybe historically you would with a mix or a bond portfolio.
Right. And a lot of that is because your dollar value will be worth less.
Right.
So you may not see your statement change,
So-
but it'll be worth less.
So what's the go forward? How do you balance the need for growth, but also the need for whether it's safety or protection or balance in a portfolio?
It really is a client-specific thing. Every client is going to be different. Some clients who are not really worried about volatility of their portfolio, finding good value stocks and things like that are going to be a place to be. People who have the ability to invest in some real estate that we may have available, that may be a good place for some clients. There are going to be some clients who we just really have to ride that wave and try to keep them enough exposure to growth assets that they can. So it's a very challenging environment, but it's very specific on each client. So I would say that if you're working with an advisor, one on our team or even your other advisors, you really need to spend some time with them talking about that, what your concerns are, how much risk you can afford to have, and help define what that risk is for you. So it's very specific this time.
Fantastic and well said. So as always, we thank you for your time. Believe it or not, our next economic update will be the last one of 2021.
I know.
And that will be here before we know it. And so if you do have questions or you want to follow up, please reach out to your advisor. And as Dennis shared, it is very client specific right now. And that's not always unique to our rules. In fact, it's probably more common than not. And so do take that time, particularly year end, always a good time too, just to kind of reevaluate where you're at. Make sure you have a good plan as you step into 2022. And with that, we will sign off. Thank you.
Thank y'all.